What are the first clues that you look for when trying to figure out what kind of market you're in?
So there's a number of measures that we look for, and generally what you're looking for in terms of the three market types is level of activity and level of conviction. And that can turn into directionality and level of market activity, if you want to boil it down, time being even. So range, breakout or volatile, and trend are the three ever-evolving fluid types of markets. And you can use a number of different tools to actually derive that. So I break it down in terms of activity and trend. So that's the easiest way of doing it. So if I want to see a market that is range bound, all right, so it's best to define the conditions, I think, a little bit of the three different types. A range-based market is one in which it holds to a consistent channel, two price levels, and it doesn't really move out of it. Okay. And as we move back and forth in that range, markets can be volatile, can bounce back and forth very rapidly, or it can do so very slowly. We've seen periods like this, like back in the summer of 2017, where volatility is really low and markets were very consistent. U.S. equity indices as a benchmark, while they were progressing, they were well within a definable range, not moving very fast or very far. Now, when we add volatility to that mix, and we still might have ranges, we get into a situation which can turn into breakouts. So a breakout is really defined as a very active market that breaks beyond a technical boundary or a established price boundary or level. And you need something of a range to define a breakout because you are surpassing that boundary. So it's the application of volatility to a range. Now, there's no guarantee that you're going to move from range to breakout, but the higher the volatility, the more likely it is to turn into a breakout. So that's why I like to look at the level of activity of the markets. And then we have a trend, and a trend is just one, it makes its own definition. You have a consistent directional movement. Now, trends can come both with high levels of volatility and low levels of volatility. We've seen slower trends or faster trends, but typically you want volatility to be middle of the road or lower, because if you have a very rapid trend, the likelihood that it's going to overextend itself and pull back is much higher. So that turns into a reversal situation, which is more of a volatile turn from a trend to a range, and where it ends up is what's going to establish that price boundary. So those three types of markets are really moving into each other. It's a range to a breakout to a trend, or it could also be a range to a breakout and then just turns into another range. But the ever-evolving movement between them is usually defined in terms of how much direction you have and how much volatility you have in the markets. And then you can establish what kind of market am I looking at, and that goes very far in determining what kind of strategy should I employ, because you definitely don't want to play a range trade when the markets are getting to be very volatile, because then you can find yourself very quickly in a losing trade.